Hello, this is the synopsis of chapter 8. And in this chapter, we go over stocks, basically just the first part of the chapter just goes over some of just a lot of the definitions and a lot of the terminology associated with stocks. So just make sure you read the chapter and understand all that. And then we talk about dividends, stock splits, and at the end of the chapter, we talk about basically the various ratios. And one thing that analysts do when they're trying to decide if they should purchase a stock or not is to look at what's called the fundamentals. Look at the ratios, which is the ratios to try to see if a company is how they're doing. You know, are they a solid company? Are they having difficulties? And so the ratios are one way to look at that. So it's important to know how to calculate the ratios, and then also, more importantly, to be able to interpret the ratios. And then the end of the chapter talks about cash flows. I don't really cover that in this class, so you can skip that section on cash flows. I know there's nothing on the quiz. Um, if it's in the study guide for exam 2, I'm not exactly sure if it's in the study guide, but if it is in the study guide, then just read about the cash flows. That means there'll be a question or two on the exam. Otherwise, just give a cursory read for cash flows. I don't really concentrate on that too much in this class. Okay, well, let's get started here then. So anyway, when you invest in a stock, of course, you're acquiring ownership in the company. And corporations corporations issue stock, and a corporation can be publicly traded or privately held. So obviously we can't invest in a privately held corporation, but we can invest in these publicly traded corporations. And so just make sure you have a basic understanding of what these different things are. Regarding corporations, just go over that real quickly in the chapter. I'm not going to spend time talking about all these definitions because you can look that over on your own in the chapter. You have voting rights if you own stock. You may get a proxy form. Most people who own stock, they just sign a proxy form, which just allows somebody else to vote on their behalf. But you do have voting rights as a stockholder. So remember, there's two ways to make money by investing in equities. You can make money through dividends, and if a company pays a dividend, and you also make money through capital appreciation, which is, of course, the price increasing. So we want to buy low and sell high, of course. So anyway, here's just some information about dividends. So if a company pays dividends, typically they will pay their dividend quarterly. And the dividend, once they announce a dividend, it'll be a regular dividend. Companies typically don't suspend their dividends because that would cause the stock to go down. That's seen as a very bad sign if they have to suspend their dividends. So once a company starts paying dividends, you can pretty much count on this regular dividend coming in. And maybe even the dividend will be increased from time to time. And typically companies, they will increase their dividend. All right, so there's something called a payout ratio. So remember, when a company has net income, there's two things that a company does with their net income. They either take some of that net income and use it to pay dividends, and then the rest goes to retained earnings. So the payout ratio is simply what percentage of earnings is the company paying out in dividends. So you just take the dividends divided by the net income. That's the payout ratio. So if you think about if a company's growing, if they're in a growth industry, you typically don't see a company that pays a lot of dividends if they're in a growth industry, if it's a growth stock, because they're using all of their net income to put it back into the company. So along those same lines, if you think about this, a company that's paying dividends or paying a substantial amount of dividends, if they have a very high payout ratio, they're probably not in a very high growth industry. and you're not going to see them growing as much because they're not reinvesting their net income back into the firm. They're paying it out in dividends. And so some people have the idea that, well, if a company is paying dividends, then they are in a low growth industry. They don't have the opportunities, because if a company had opportunities for growth, they wouldn't be paying dividends. So some people see dividends as kind of a negative. Personally, I don't see that as a negative. It's just, you just have to understand that if a company is paying a steady dividend and a healthy dividend, then you're not going to see the capital appreciation. For example, if I invested in ExxonMobil pays a really good dividend. You can also Google, companies that have high dividend yields. So if I had a company that was paying me regular dividends, and a lot of oil companies in particular, they pay pretty good dividends. I wouldn't expect to see a lot of capital appreciation, but that's okay, because I'm not expecting to see a lot of volatility with that stock. So what I'm trying to say is companies that have a high dividend payout ratio, they tend to be in more lower growth or slow growth environments, and the stock is not going to be as volatile. So in my portfolio, I might have some pretty good dividend payers to give me some stability, because if the stock goes down, or if the market has a downturn, I'm still getting that dividend. But then I would also have some stocks that are in growth industries, maybe Tesla, um, Apple. Apple pays a dividend, but it's very small. Let's see what else. Facebook. Just think of some companies that are in really newer companies, or companies in high growth industries. You're not going to see, they will either not pay a dividend, or the dividend will be very small, but you're going to make your money in capital appreciation, but they're going to be more volatile. Okay, so anyway, getting back to this, payout ratio is simply dividends divided by earnings. The retention ratio is just 1 minus the payout ratio. So if a company is paying out 60% of their income, net income in dividends, then they're retaining 40%. So the payout ratio is the retention ratio is 1 minus the payout ratio. All right, so if a company has higher earnings, that typically does tend to lead to increased dividends. So for example, I just thought of some other companies that pay a pretty steady dividend. Pharmaceutical companies like Johnson & Johnson, Merck, also, let's see, a lot of your consumer, retail consumer type of companies like Kraft, Procter & Gamble, Coke, Pepsi. Those kind of companies pay a steady dividend and have increased their dividends steadily over time. So if you have a company that's paying steady dividends like that, you can also expect to see an increase in dividends as because their earnings tend to increase. Also, if a company has lower earnings, that typically doesn't result in lower dividends, because like I said, once a company announces their dividends, they stick to that. They might increase them, but they're definitely not going to decrease them, because that is going to be seen as a very bad sign and will cause their stock to go down. Okay, these are just some different some different dates. They'll distribution dates and when they announce the dividend and so forth. So just skim this briefly about these different dates, and just make sure you understand what each of these dates mean when you go over the chapter. Now, dividend reinvestment plans. So when you buy stock, they'll ask you, do you want to reinvest the dividends? I typically will say yes. So what this means is that when like if you have a Schwab account, for example, when a company pays a dividend, it'll come to you in cash. All right. And you'll see for like one day, it'll be in cash in your account. And then the next day, Schwab will reinvest the dividend in the stock. And so if you click that you want to have the dividends reinvested, then whenever a company pays a dividend, it's going to automatically be reinvested in the stock. So that's how you end up with these fractional shares, because let's say you get a dividend that amounts to $45.20 and the stock is trading for, let's say, $89. You're going to get around half of a share. And so it's convenient, instead of, getting all this cash, getting all these dividends in cash and then having to go in and reinvest them. It's kind of nice to have the automatic reinvestment. It used to really mean a lot more, though, to be honest with you, when back before Robinhood forced all of these brokerage firms to suspend or to eliminate their commissions. It meant a lot more when we had to pay commissions. So if you were paying a commission every time you bought a stock or sold a stock, it made a lot more sense to click the dividend reinvestment button, because you were automatically getting those reinvested without a commission. But now that there's no commissions, it's not as important. But like I said, for convenience, I usually will pick the dividend reinvestment plan. And if you don't click that box when you purchase a stock, you can always go back in later and select that. All right. So when a company pays a dividend, it doesn't affect the proportion of the ownership. It just so that's important. Sometimes these people will have, like, there might be a family or there might be a group of people who have a controlling interest, let's say 51% interest in a stock, a consortium, if you will. And so they don't want that diluted. And so they're just saying here that stock dividends, when they pay a dividend, it doesn't change the ownership share. All right. Now, stock splits. Periodically, a stock will split. So what this means, for example, if you go back and look at companies like ExxonMobil, companies that have been around for a long time, they've had several stock splits over the years. And typically, the reason for a stock split is just to make it easier for people to purchase the stock, because look at Amazon. Personally, I don't know why Amazon hasn't split. Amazon is trading for, I don't know, $2,000 or $3,000 a share. It's ridiculous. It's kind of difficult to buy those shares. So, I really can't answer the question as to why they haven't split. But a lot of companies, once a stock gets above a certain price, they'll have a split to make it easier for people to purchase. For example, the last one of the splits, most recent splits that comes to mind is Apple. Last year, Apple went up to $700 a share, and they had a 7-for-1 split. And so if you had one share of Apple at $700, and they did this 7-for-1 split, when you woke up the next morning, instead of having one share at $700, you had 7 shares at $100 each. So when a company has a stock split, it really doesn't mean anything other than the fact that you have more shares and the price is lower. So typically you'll see a 2-to-1 split. So let's say you had a stock that was it's at $100. Excuse me. It's at $100. You have one share at 100. They do a 2-for-1 split. You wake up the next morning, you have 2 shares at $50. And so, like I said, it just makes them easier, these stocks a little bit easier for people to purchase, makes them more marketable, if you will, or a little more liquid, if you will. And so that's it. So anyway, when a company announces a stock split, that's actually a good sign. And once they announce a stock split, that usually makes the stock go higher. So if you think a company is going to split, definitely you should buy that company. Now, why does a stock split make the stock go higher? Because think about it. The company would not be announcing a split, unless they thought the price was going to go higher, right? So it's seen as positive news. So anyway, that's a stock split. It can be 2-for-1, 3-for-1, 4, 5, 6, 7, even 10. But normally it's like 2-for-1 or 3-for-1. Now they can also have reverse splits. So if you have a company, let's say it's a high tech company that was this high flying stock. Let's say it was trading at $100 or $50 and it's all the way down to say $5 a share. They'll do a reverse split. The reason they do this is because when the stock gets really low, like under $10, and I think if a stock is under $5, I think it actually is a $5 amount. Certain institutional investors, like insurance companies and retirement firms, these large institutional investors, they're not allowed to buy stocks that are below a certain amount. I think, and typically it's $5. And so they will do this. If a stock goes way down like that, they'll do a reverse split so that it makes it easy so that these institutional investors can invest in it, because it's kind of like a domino effect. If the stock goes down and then these institutional investors can't invest, then it goes down even more. Another reason for a reverse split is to eliminate the speculative trading. And so let me explain what that is. So let's say you had $1,000 to play with, okay? And you were trying to day trade. So if you bought a stock for $100 to try to get in and out in a day to trade and make some money, if you only had $1,000, obviously you could only buy 10 shares, right? But let's say that a stock was down to $1 a share. Well, you could buy 1,000 shares of it, okay? So if you bought 1,000 shares of that stock at $1 and it happens to go up 5 cents or even a penny, you can make quite a bit of money by day trading. And so what happens with these stocks when they get below $10 a share, you end up with these day traders who come in and try to buy these large blocks to make some money on these price swings. And so that's another reason for the reverse split, to try to eliminate that. So what does a reverse split mean? Well, let's say that you had a stock that had gone down to $5. Let's say you had, let's say it was at $10. Let's say you had $10. Let's say you had one share. Well, let me think this through. Okay, let's say you had $10. Let's say you had 10 shares at $1 a share. Okay, then if it did a 10 for 1 reverse split, you just multiply that by 10. It's going to be instead of $1 a share, it'll be $10 a share. So you'll have fewer shares, but the price is higher. So let me think of an easier example. Let's say a stock was $10 and you had 2 shares. I'm sorry. Let's say you had 2 shares at $20 and they did a 1 for 2 reverse split. You have 2 shares of the stock at $20 a share. When you wake up the next morning at a 2 for 1 reverse split, you would have 1 share at $40. Instead of 2 shares at 20, you have 1 share at 40. So that's what a reverse split is. You multiply the dollars and you divide the number of shares that you have. So anyway, during the whole .com bubble, when that burst in the early 2000s, you saw a lot of those reverse splits. So like they would have like a 1 for 10 reverse split, some of them, to get it from $10 back up to $100. So anyway, that's what a stock split is. And here's some examples. Here's one example here. Okay, sometimes corporations will repurchase their stock. This is also a good sign. So if the price is down and if the stock is undervalued, you might see companies repurchasing their stock. So this is considered to be a good sign too. So if you find out that a company is repurchasing their stock, or there's talk that a company might repurchase their stock, they obviously wouldn't repurchase their stock. They wouldn't be buying shares in the open market if they thought the price was going down, right? It means they think it's going up. So that's usually seen as a good sign and causes the stock to go up when they're repurchasing shares. All right, preferred stock think of that as a hybrid between stocks and bonds. So if you don't want the risk of a common stock, but you want to make a little bit more money than you probably would buying bonds, you can buy preferred stock. So preferred stock is just stock that pays a set dividend of a certain percentage. And they, so that's basically what preferred stock is. It's not really that common. Most people want the money, they want to make, they want the volatility of the common stock because you can make a lot more money there. But if you want to have if you want a fixed dividend, then you buy preferred stock. All right, so next we're going to talk about the analysis of financial statements. So these ratios allow you to compare companies, one company versus another company. So you've all looked at financial statements. You've all had Finance 302. You've had some accounting classes and so forth. So just looking at these financial statements, the balance sheet and the income statement, it's hard to really gauge how is a company doing. I mean, you can look at the net income and so forth, but how is the company really doing? It's just looking at all these numbers, it can be difficult to see. And also, it's really hard to compare one company to another or a company to its industry, and if you're just looking at the numbers, because companies can have, you can have size differences in the financial statements and so forth. In other words, if you have one small company and a competitor is very large, you're looking at these different denominations and it can be difficult. So basically ratios can allow us to compare apples to apples. All right, so let's take a look at, and also it allows us to do a cross-sectional analysis, meaning we're comparing our company to a competitor or the industry. And it also allows us to look at a trend. So when you're looking at these ratios, it doesn't really mean a whole lot unless you can, one, compare to a competitor or the industry or several competitors, and two, look at least 3 years to see how the company's doing. Look at a trend. Okay, so um, let's look at some of the balance sheet. We're going to look at balance sheet ratios and then income statement ratios. So let's take a look at the liquidity ratios first. Current ratio. All right, so remember the current ratio is simply the current assets divided by the current liabilities. So assets we have for just the year, current assets, current liabilities, bills that are due this year. So so basically you just take your current assets, you divide that by your current liabilities. Here we get 1.74. You can follow in the book with these, where they're getting these numbers from with the balance sheet. So what does this mean? It means, so this is times 1.74 times. This means we have enough current assets to pay our current liabilities 1.7 times over. Or another way to say it, we have $1.74 in current assets for each dollar in current liabilities. So this doesn't really mean anything unless we are looking at comparing it to competitors or the industry average. So you'd want to look at, compare to the industry average if you have those figures, or competitors, to see, what does this look like? Is this less than the industry or competitors, or more? So in other words, by itself, these numbers don't mean a whole lot unless you need to compare them, as I said, to several competitors or to the industry average. All right, now the quick ratio. So remember, current assets consists of cash, accounts receivable, money we're expecting to get from our customers, and inventory. So inventories aren't real liquid. If you wanted to, if you needed to really get some cash real quick, we don't consider inventories to be that liquid. We have to sell off our inventories. So the quick ratio is just basically saying, let's just look at our most liquid assets and use that to calculate a ratio. So it's current assets minus inventory divided by current liabilities. That's going to be a lower number, of course, 1.19 times. So we have $1.19 in liquid assets for every dollar in current liabilities. Or we have enough in liquid assets to pay our bills 1.19 times over. It's not uncommon to see this number below 1, which is not really an issue. Again, you want to compare that with your industry. Okay, activity ratios. This is inventory turnover, and so this is just sales divided by your inventory. Here they're saying average inventory. They're taking an average of the 2 years or what have you. But really it's just sales over inventory. So how often are you turning over your inventory? Typically the higher this number, the better, because it shows that you have a very efficient inventory system. A lot of companies have a just-in-time inventory system where as soon as something is about to run out, they'll wait until it gets to a certain level, and then they'll have new items will automatically be ordered to replace it. And so generally, as I said, the higher the number, the better, because it shows that you have an efficient inventory system. But think about this, if the number were really high, like say the industry average is 12 and you're at 20 or 25, well, that might be a red flag. If your inventory turnover is super high, it could mean that you're running out of things, or that you've got customers who are coming in there to buy stuff and you're out of stock. So excuse me, generally the higher the better, but an extreme high number could mean that you're running out of stuff. An extreme low number or a low inventory turnover can mean two things. You either are holding too much inventory, or you're holding obsolete inventory. You've got stuff that nobody wants, or you've got too much inventory if the number is too low. Okay, average collection period. This is also called days sales outstanding. What all this is telling us, and this is days, this is 23.7 days. This is just telling us from the time you sell something, how long does it take before you get payment from your customers? Typically, this is 30 days. So this company's doing pretty well, because normally companies have what they call a 210 net 30 policy, where 210 means if a customer pays within 10 days, they get a 2% discount, and the net is due within 30 days. So, and this is just simply accounts receivable divided by daily sales. So it's accounts receivable divided by sales over 360 or 365. You can use 365 or 360. The only reason they're using 360 here is because that gives you a more round number, but it doesn't matter whether you use 365 days or 360. So accounts receivable divided by average daily sales, and they're at 23.7 days. I suspect this is a good number. Typically the average is 30, as I mentioned. All right, receivables turnover. The higher the better here, because it means that you're collecting your receivables sooner. This is simply sales over accounts receivable. Okay, your fixed asset turnover. This is an efficiency ratio. This is showing how efficient, how much sales are we able to generate from our fixed assets. So that's land, plant, and equipment. And so generally the higher the better, because it means that you're generating more sales from your from the fixed assets that you have. And this is times, again, 3.9 times. Okay, this is total asset turnover. How much sales are you generating from all of your assets, from your total assets? So sales over total assets, and this is 1.4 times. So it's kind of, looking at these ratios is kind of like a puzzle. For example, if your fixed asset turnover was a good number, but, well, actually it's just the opposite, but let me continue with this thought. Let's say that the fixed asset turnover was a really good number, but then this total asset turnover was a bad number. Well, then you would look to your current assets, because when we went from fixed assets to total assets, we included our current assets. So then you would look and see, well, so what's the problem? Is my inventory too high? Is my accounts receivable too high? Now, if your inventory were too high, it would also show up as a low inventory turnover ratio. So you can look at these different ratios to kind of solve the puzzle, if you will. If your days sales outstanding was a very high number, meaning it's taking you a long time to get your receivables from your customers, that could also be why your total asset turnover could be high, or could be low. So you can you can look at different clues, you can look at these various ratios to give you clues as to why they might be high or might be low. So let's look if you look here, their fixed asset turnover is 3.9. That's a pretty good number. This is a lower number. The total asset turnover is a lower number. So probably what's going on here, let's see. So the fixed asset turnover, that's a good number. But when we go to the total assets, it goes down. And so what that's telling me is that probably if this is lower than the industry average, maybe they have too much plant and equipment. Maybe they've got some obsolete plant and equipment. Okay, anyway, the point I'm making is you can look at these some of these ratios have a relationship to one another, and you can look at these various ratios to get some clues as to what some problems might be. Okay, let's look at the profitability ratios. All right, so the gross profit margin, simply your sales divided by your cost of goods sold. So everything that goes into the cost of selling your products, divide that by your sales, and you get your profitability ratio, your gross profit margin of 41.4%. So again, you want to look at their compare this to competitors and the industry average and so forth. All right. All right. So the operating margin is your operating earnings. Okay. So this would be your EBIT divided by your sales. That's given us 17.3%. And then your earnings after taxes, this is the bottom line. Basically your net income divided by sales, and you get your net profit margin. So this is the one that I like to look at, is basically the bottom line, net income divided by sales. Okay, now let's look at the ROA, return on assets. That's your net income. They're saying here they're making this more complicated than it needs to be. Your earnings after taxes, that's your net income. So your bottom line, net income divided by total assets. So this is just showing, how much net income are you able to earn off your total assets? Higher the number, the better. Of course, with all these profitability margins, the higher the better. And then return on equity, that's your net income divided by, the total equity. So you look at you get your net income here from the income statement, and then this is going to be your retained earnings. This is the common stock plus retained earnings. This is the total shareholders' equity. And so what this return on equity is telling us, and this is from, of course, the balance sheet, the denominators from the balance sheet. So what this is telling us, this return on equity, how much return are we able to get, or is the company able to generate from the money that the stockholders have given them? So 72% this is a pretty good number. This is telling us that for every dollar that we have put in as shareholders, they're able to earn they're earning 72 cents on every dollar that we have put in. Now this is a really high number. So if I were seeing this, then I would go and look at the debt ratio, because the debt ratio, how much they've taken on in debt can affect the return on equity. Let's see what their debt ratio is. See, their debt ratio is 80%. Okay, so let me explain what I mean here. So let's say that, okay, so this is the net income. Okay, let's look at this formula. Here's the net income and here's the equity. Retained earnings and total common equity, total common stock plus retained earnings. So let's say that a company has they take on this huge project and they finance it with debt. In other words, they issue bonds. So their debt ratio increases. So they've taken on this huge project. They haven't issued any new stock to finance it though. It's all been issued with debt. if the project's a huge success and their income goes up. So what's going to happen to the return on equity? Well, their net income went way up, but because they financed all of this with debt, the equity stayed the same. So that can make the return on equity go up. So if you see a big increase in return on equity, then you should look and see, well, what's happened? Have earnings, is it because they really are more profitable? Is it because they're making more money off of the equity, off of the equity that we've contributed, or is it just because they've increased their debt financing? So anyway, the point I'm making is if you see a change in ROE, you also have to see if there's been a change in the debt ratio. That would give you part of the answer possibly. Okay, so anyway, ROE, just to sum up here, return on equity, how much return are they generating off of the money that the stockholders have put in? This is 72%, so that's a pretty hefty number. ROE of 72% means for every dollar the shareholders have put in, they're generating 72 cents. All right. So this is, here's their debt ratio. So the debt is debt divided by total assets, and we have a debt ratio here of 80%. So what does this mean? It means that 80% of their capital is being funded with debt. Only 20% is being funded with equity or with stock. So, these debt ratios, more than any of the other ratios, in my opinion, you really need to look at the industry average and look at the competitors to see what is a typical debt ratio for that industry. Because certain industries can have higher debt ratios, which are perfectly acceptable. Because this seems high to us, but maybe it isn't high depending on the industry. Industries that are stable and industries that have regular cash flows coming in can accommodate higher debt ratios. So think about the grocery industry. Fairly stable industry, constant cash flows coming in. So if you have regular cash flows, you can take on a higher debt ratio because it's more stable. But if you're in an industry like, the biotech industry, for example, or, some computer services industry, an industry that's new and not very stable, your cash flows are not going to be that regular. And so you can't have as high of a debt ratio. All right. So anyway, debt divided by total assets. How are they getting the debt? Okay, you look at the liabilities on the balance sheet, and you look at your notes payable in your current liabilities, the notes payable plus long-term debt. So the total debt is notes payable plus long-term debt divided by total assets. That gives us the debt ratio. Okay, then we also look at the debt to equity ratio. So I like to just look at the debt ratio. 80. This gives us a really, to me, it's easy to understand. Let me go back to this. 80% of their capital is being funded by debt, 20% with equity. Okay, debt to equity ratio. Think about if this were 1, the debt ratio would be 50% if the debt to equity ratio were 1. If they had equal amounts of debt and equity, this would be 1. So a debt to equity ratio of 4 times means they have 4 times the debt to equity. If it were less than 1, then they have more equity than debt. Okay, times interest earned. This is earnings before interest and taxes, EBIT, divided by interest expense, the interest expense. So this says that we have enough earnings before interest and taxes to make our interest payments 11 times over. So here, in this situation, the higher the better. If you were thinking of investing in this company, investing in their bonds, this tells you, well, they won't have any trouble making their interest payments. If this were, a very low number, then you might want to think twice about investing in their bonds, because they could possibly have difficulty making their interest payments. Anyway, that's the TIE times interest earned. Simply shows how much earnings they have, how many times they can make their interest payments based on their earnings before interest and taxes. Okay, so as I mentioned, the ratios are helpful to compare with competitors and within the industry. There's some problems with these ratios, though. See, they're not really mentioning what I typically talk about for this, but some of the problems with the industry averages or with the ratios are they're just averages. You know, sometimes it's hard to tell if a company is doing well or poorly because some ratios are good, some are bad. And also these are just industry averages. So if your industry is just average, that's really not that great of a thing, right? You can also have seasonality issues. If some companies have the bulk of their business during one part of the year, that can make it difficult to compare with other companies because of seasonality. Accounting, differences in accounting. For example, FIFO versus LIFO, the way you do the inventory can cause the ratios to be different. So you just want to make sure that you read the notes. If you're comparing two companies that if they have different accounting methods, then you're going to get different, the ratios are going to be different. Let's see what else. Different sizes. Some, let's say you're a company, you have a company that just produces one product and you're trying to compare yourself to a company that produces many products. So let's say that you make, I don't know, let's say you're Tom's toothpaste. You only make toothpaste and you're trying to compare yourself with Procter and Gamble. Well, they have, a multitude of products. So if you're trying to compare your one company product to a conglomerate, that's not going to be a good comparison either. So anyway, those are just some of the problems with the ratios. But overall, ratios are nice to look at to give you some idea of how the firm's doing. So creditors use the ratios. Investors use the ratios. Let me go back to this. So if you're thinking of, creditors who are thinking of loaning money to the firm, or if you're thinking of buying bonds for the firm, you're going to use those ratios. Of course, stockholders will use the ratios to see how to try to find out the health of the company. Let's see. All right. And then also the managers at the company, people, people who work at the company, they want to look at the ratios too to see how they're doing. Another ratio that is very important is the PE ratio. That's used by what?
Where's the cocktail?
In the drawer, in the left hand. I'll be done in a minute. I'm recording.
I'm doing some. Where's the tip?
In the drawer, right hand drawer, right in the drawer of the laundry room, in the drawer. Okay, sorry about that interruption. So the stockholders will use a very important ratio that they use is the PE ratio. Hang on, I got to shut the door. Oh, that's a problem from working at home. Sorry. All right. So the PE ratio, price per share divided by earnings per share. And so if you think about that, if you take the company's, the price of the stock and you divide by their earnings per share, which is their net income divided by the number of shares outstanding, that gives us something called the PE ratio. So you're going to want to look at that. And I'll talk more about this when I do the synopsis for the project for the stocks, because that's one of the fundamentals that you should look at. So with the PE ratio, price per share divided by earnings per share, that tells you how much someone is willing to pay for the stock. Excuse me, how many times earnings. So if the PE ratio is 10, investors are willing to pay 10 times earnings for that stock. If the PE ratio is 20, investors are willing to pay 20 times earnings for that stock. So generally within a range, the higher the PE ratio, it's seen as a positive sign. At an extreme though, for example, if I saw a range where a company was from 10 to 20, a range of 10 to 20 on these PE ratios, I would want to buy a stock it's in the high range because it shows that it's more favorable. That's a better company. Investors look more favorably upon a stock with a higher PE ratio. So let's say the range is 10 to 20, but then I see a stock in that same industry that has a PE ratio of 50. Well, then I would go and look at the chart to see if maybe the stock has had a huge run up in price, because probably, yeah, that's a good company, no doubt. But a 50 PE ratio when the range is 10 to 20 probably means that because of some irrational exuberance, news, whatever, that stock has probably had a huge run up and it might be overvalued and due to come down. So anyway, that's not mentioned in the slides, but PE ratio is another very interesting ratio to look at because it includes it. Instead of just looking at historical information, it's looking at the current value of the stock. And it's one that shareholders use, one of the more important ones that shareholders use. All right, as I mentioned, just briefly take a look at the cash flow analysis. I don't really spend a lot of time on that. And if it's, as I mentioned, I can't remember if it's in the study guide, but if it is, then just just make sure you read it in the slides and read it in the chapter. But I don't really spend a lot of time on the cash flows. Okay, that's it for today's synopsis. Take care.